Have you ever wondered how governments pay for everything? Most people think it's through taxes. The income tax you see on your paycheck, the sales tax you pay at the store, or the property tax on your home. These are what we call visible taxes. You see them, you feel them, and you can complain about them. But what if I told you there's a much larger, more insidious tax that most people don't even realize they're paying? A tax that silently drains your savings, erodes your purchasing power, and quietly transfers wealth from you to the government and the financial elite. This is the hidden tax of inflation. To understand how this system works, we need to look back in time. Let's travel to revolutionary France. The new government was broke. They had just overthrown the monarchy and needed money to fund their new republic and wage wars. So they came up with a brilliant idea, print paper money called assignats. These notes were supposedly backed by the vast land seized from the church. It seemed like a perfect solution. Instead of taxing people directly, they just printed new money to pay their bills. At first, it worked. The economy seemed to boogie, and the government had all the money it needed. But there was a problem. The temptation to print more was just too strong. Whenever they needed more funds, they just fired up the printing presses. Soon, there was a flood of assignats chasing a limited amount of goods and services. Prices skyrocketed. A loaf of bread that cost a few sous one day cost a few hundred the next. People's life savings, held in this paper money, became worthless. The result was hyperinflation, social chaos, and economic ruin. It was a brutal lesson. When a government has the power to create money out of thin air, it can't resist the urge to abuse it. Fast forward to the modern era. You might think, well, that was a long time ago. We're much smarter now. But are we? The same fundamental mechanism is at play today, just in a more sophisticated and less obvious form. The big turning point was 1971, when the United States officially abandoned the gold standard. Before then, the US dollar was convertible to gold at a fixed rate. This put a natural limit on how much money could be created. You couldn't just print more dollars without having more gold to back them up. But after 1971, the dollar, and by extension most global currencies, became what's known as fiat currency. Fiat is a Latin word meaning, let it be done. In other words, our money has value simply because the government says it does. It's backed by nothing but trust and a legal decree. This single move handed governments and their central banks the modern equivalent of the revolutionary French printing press. But instead of physical printing presses, they now have a digital keyboard. With a few keystrokes, they can create billions, even trillions of dollars, euros, or yen out of thin air. This power is used to implement what I call the three great tricks of modern finance, all designed to silently extract wealth from you. The first trick is the policy of perpetual low-level inflation. You've probably heard central bankers mogpio a 2% annual inflation rate. They present this as a sign of a healthy, growing economy. But let's be clear about what 2% inflation really means. It means that the money in your savings account is guaranteed to lose 2% of its purchasing power every single year. It might not sound like much, but over time, it's devastating. A 2% inflation rate will cut the value of your money in half in just 35 years. So, the nest egg you've worked your entire life to build will be worth only half as much by the time you retire, if you just leave it in cash. This isn't an accident, it's a deliberate policy. It's a slow, steady, and guaranteed transfer of wealth. As your money loses value, the government's debts, nominal and denominated in that same currency, become easier to pay back. They are essentially defaulting on their obligations in slow motion, and you are the one footing the bill. The second trick is far more subtle and is known as the Cantillon Effect. This principle, named after an 18th century economist, describes how new money enters the economy. It's not distributed helicopters dropping it from the sky for everyone to grab. Instead, it's injected into the financial system at specific points. The first recipients are a privileged few, the government itself, large banks, and well-connected financial institutions. They get to spend this new money before it has had a chance to circulate and cause prices to rise. Imagine you're the first person to get 1 million newly created dollars. You can go out and buy assets, stocks, real estate, fine art, at their current prices. But as that new money ripples through the economy from hand to hand, it bids up the prices of everything. By the time that money reaches the average person, the wage earner, the retiree, the prices of goods and services have already gone up. Their salaries and savings haven't caught up, so their real purchasing power has decreased. The Cantillon Effect is a mechanism that systematically benefits the wealthy and those closest to the money spigot at the direct expense of a regular Joe. It's a major driver of the widening wealth gap we see today. The third and final trick is financial repression. This is what happens when governments and central banks deliberately keep interest rates below the rate of inflation. For most of modern history, if you put your money in a safe savings account, you could expect to earn an interest rate that was higher than inflation, allowing you to grow your wealth safely. Not anymore. Today, the interest rate on your savings account is probably close to zero, while official inflation is, let's say, 3%. That means you are guaranteed to lose 3% of your purchasing power every year by being prudent and saving. This isn't a market failure, it's a policy choice. It's designed to make saving money in a traditional way unattractive. It forces you, the average citizen, to take on more risk to protect your wealth. You're pushed out of safe savings and into the stock market, real estate, or other speculative assets just to try and keep up with inflation. This props up asset prices, making the rich, who own most of these assets, even richer. Meanwhile, you're forced to gamble with your life savings. It's a rigged game where saving is punished and speculation is rewarded. So, let's put it all together. The core message is this: inflation is not some natural, unavoidable economic weather pattern. It is a policy. It is a choice. It is a system of taxation without legislation. It is a stealthy and effective way for governments to fund their spending and manage their debts by devaluing the currency you work hard to earn and save. Through the combined effects of perpetual inflation, the Cantillon Effect, and financial repression, we have a system that continuously transfers wealth from the working and middle classes to the government and the financial elite. The greatest trick modern finance ever pulled was convincing the world that this system is normal, necessary, and even good for us. They've managed to frame a hidden tax as a sign of economic health. They've disguised a wealth transfer mechanism as complex monetary policy that's too difficult for the average person to understand. But it's not. The principle is as simple today as it was in revolutionary France. If you give someone the power to create money, they will use it to their own advantage. Understanding this is the first step toward protecting yourself and demanding a fairer system. Thank you for watching. If this video opened your eyes, please hit the like button, subscribe to the channel, and share it with someone who needs to hear this message. Let's spread the word. See you in the next video.